Well, hi everyone, and welcome to the Buffett and Beyond Research Saturday Market Recap for August 24th, 2024. And remember, if you want to live on the beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. Don't forget that if you want a full free month subscription to any of these videos that we have, we put out 3 a week, 3 different videos on a Saturday. You get the 3 videos, and on Tuesday, Wednesday, Thursday, and Friday, you get a letter on the market and timing the portfolios. All we need is your name and email. We want you to get a free month subscription so you can see what we're all about. All you have to do is go to buffettandbeyond.com. Buffett is spelled with 2 F's and 2 T's, buffettandbeyond.com, and give us your name, your email, and you'll start getting a full month free subscription to our letters. And this week, the market, well, we had another positive week as Fed Chief Powell told the world that he, the Fed, would be lowering interest rates. He insinuated it's time the Fed changed its position relative to interest rates. And our weekly stock analysis video, well, last time we looked at Mercado Libre, stock symbol MELI, M-E-L-I. We said it was a buy, and boy, oh boy, were we right on the money. This stock is now up 250% in 5 years. This past week, MELI surprised the market and put in a 4th of July rally. Wow. And our ETF video, well, we discussed why our top stocks in our QQQ portfolio of 11 stocks returns more along with less volatility than the top stocks in the tech ETF. It can also be hedged easier and better. And the reason we like 11 stocks or 12 stocks better than 6 stocks is because of the volatility. And most of those tech stocks, those 6 tech stocks, are in our 11 stock QQQ portfolio. So we win all the way around, folks. Let's take a look. And this week, the top QQQ portfolio, or the top 11 stocks in the QQ portfolio, up 34.5%. This is year to date. And if you're hedged, if you were timing the hedges as we were, you can add another 7.7% to this 34.5 for a total return of 41.2%. Sector stars, same thing. I'm 29.2. If you were using our hedges, then you could be up as much as 34%. And the 30 growth stocks up 22.6%. If you were hedging that, you could be up as much as 30%. And the S&P is up 17.8%. So our 3 main portfolios are all outperforming the S&P 500, and we could add hedging to any of those portfolios, folks. So if we get caught in a downturn, we want some hedging to be there with us. And what we do is we use an inverse ETF. We don't have to hedge the whole portfolio. We hedge about 30% of the portfolio, just to ease that downward slide in the overall market and also make some money on the downside. So when the market turns around and we add to our portfolio, we can either buy some more stocks with it or we buy the QQQs and we can make some money on the way up. So let's take a look at the S&P 500, and we can see that it fell down below this volatility band down here, and then for 2 days it closed right at that band. Very, very scary in there. And then it started taking off, went right through the 20-day moving average and right up to almost the top band. And now it seems to be stalling out a little bit here at this level. And we're going to show you something in a second. In fact, that second is here. We are looking at the Dow Jones Industrial Average, and you can see we are at this top in here. So if it fails, we have a triple top, which is not too good, but right now it's going up. You could see we have, if the market turns down, we have a little sell signal in here, and it all depends what happens Monday and Tuesday, because don't forget, next week, or this coming week I should say, is the last week of the month. And so usually in the last week of the month we get what's called a pit bull low. The market goes down, then it turns around and it winds up closing up for that week and for the first couple of days of the following new month. Reason? because at the end of the month, all the portfolios readjust themselves, the mutual funds and the hedge funds, and then the first couple of days of the following month, the IRA money comes in, the 401k money comes in, trust money comes in, and so the market tends to rally at that point. And also this coming weekend, we have a long weekend, don't we? It's the holiday weekend, and over here in the U.S., we celebrate Labor Day on Monday, so we have a 3-day holiday, and usually the market is positive going into a 3-day holiday. The market just loves holidays. So we have to be a little bit cautious about this little sell signal up here, but if the market goes down Monday and Tuesday, we should expect a rally going into the weekend. Now let's look at the S&P 500, and you could see that this little sell signal up here was a little bit more pronounced than on the Dow. And when we look at the QQQs, which is the NASDAQ 100, we could see this little sell signal up here, barely see it, but it depends where it closes on Friday, because I'm recording this just before the market closes. It's closing up, but you can see this line is just not as high as this level here, and that if the market is down Monday or Tuesday, that would give us a short-term sell signal. But right in here, our intermediate term signal is still pointing up, so that's good. The problem is that the volume, these green vertical lines, the volume when the market closes up is starting to dry up. And so it's like everybody's on vacation already. And this blue line, 50-day moving average, and that's what the market is trying to hold right here, this 50-day moving average. It's defending itself very nicely today. Again, I'm recording this on Friday before the market closed. It's defending it. Thursday was a nasty drop, and boy, oh boy, this went right down to the 50-day moving average, and this might be an inside day today, which is not positive for the market, at least at this point, but we have to wait and see how it closes before the end of the day. And Monday and Tuesday are very important. And Monday, again, if we see the market drop, if it's weak Monday or Monday and Tuesday, then that might be the pit bull low, and we could rally into the end of the month. Portfolio protection, yep, we have our 3 puts in here. This is about $140,000 portfolio. Some of you asked about that. So for $100,000 portfolio, you could be looking at 2 puts, which would be fine, as long as you have that disaster protection in place. And I would go out a couple of months with those 2 puts. So if you have a $100,000 portfolio, the October put and the November put, and these are the SPYs, and they're about $475. And if you have a $140,000 portfolio like this one is, you could have the 3 puts in here. So you're protected just in case the market does something silly, or there's an exogenous event, which means somebody does something silly, chemical, biological, or whatever, something that we pray never happens. But at least we're protected just in case the market does have a hissy fit. Interest rate or change in the thought of interest rates or something like that, anything can happen, and we're happy that it very rarely does. So there's your portfolio protection, and this is separate from the hedges, because the hedges, we have to see the market turn around and either get ready to go up or get ready to go down, and that takes a couple of days. This portfolio protection using the puts, it's if something happens immediately, such as Black Monday in 1987. That was a day the market was down 22% in one day. Not a fun time at all. So folks, we had another good week this week. We'll have to see what happens next week, but we think next week, after all is said and done, we'll have a very, very slight pit bull low, and then we'll rally into the end of the week, or we think so anyway. So forget about the market for now. Go out, enjoy yourself, go for a walk, be safe, be with your family for Sunday dinner. So take it easy, and we'll see you. Have a good weekend, and we'll see you back here on Tuesday.